Let's get straight into the conversation around what has just happened over at the Fed. I was thinking of ways to characterize this, and I know I said earlier what goes up must come down, but you could probably also call this the pivot pushback. Equity investors certainly did not like what they heard from Chair Powell overnight.
Yeah, I guess they're really sort of just trying to focus people on what pivot means. Pivot does not mean move from 75 basis points to nothing, or let alone reversing policy tightening and moving to an easing stance. They're just saying that it actually means a slower pace of rate hikes. And I guess, if you think about it, they're focused on this 12 to 18 month lag. They still feel they need to do some more work, but they're a bit uncomfortable about trying to time it at 75 basis points rate hikes. So they want to move to a slower pace. Obviously, the labour market data we've seen so far this week has been very strong. We're going to have the employment report coming out in the coming days. So that's going to be really important. But they're just sort of saying, we're not comfortable going at the current pace forever, obviously. We're going to move continuously until we get some sort of signs that we're going to see inflation coming under control.
So it seems as if the Fed is still going to be data dependent, because Chair Powell hinted that the pace of hikes could moderate, but also said that rates still need to go higher in order to tame decades high inflation. So do you think that 5% is indeed going to be the peak, as the likes of Goldman Sachs have suggested, or do rates need to go beyond that in order to really hit inflation on the head?
Well, I guess on your first point, it would be a bit worrying if the Fed wasn't data dependent, right? Because they need to be looking at the data and trying to predict what's going to happen in the future. I think, obviously markets now effectively pricing in a 5.25% terminal rate. So even above the 5% you talked about. And I think it's going to need to see some significant weakening in some of the macro data for them to back off from that sort of trajectory. So the employment data, we're talking about needing to almost go to around 100K a month, maybe slightly below, to see some of the slack being created in the labour market. We're still quite a long way from that. And that suggests that wage pressures are going to remain a force for inflation in the coming 12 months or so. So I think, it's very clear that they're going to be hiking your rates into the end of the year and probably through Q1 as well now. And that's going to be that's obviously going to be a challenging environment. So we've been talking about equity markets as being a bear market rally. So we still think there's probably going to be one last leg down for equity markets before we form a proper base. And I think what we heard last night is consistent with that view.